With mortgage rates at rock bottom levels and with house prices very low in relation to household incomes, housing is about as attractive a purchase as it has been in the past 40 years. That's according to Northern Trust economist Paul Kasriel. We're joined now by Dan Alpert. He's the founding managing director of Westwood Capital and a noted investor in real estate. Dan, do you think Paul is onto something here?
Well, he can't be wrong about its affordability. That speaks for itself. Problem is whether or not housing is a good asset to invest in right now relative to short-term moves in pricing. I mean, we expect to see additional retrenchment in pricing. We think that off of the May 09 lows, we expect housing to go down between another 5 and 8% between all this is done, between the time of now and when it's all done. But the fact is that long-term housing has a very, very different complexion to it than it does over the short and medium term. The affordability is pretty much here to stay. I believe we're going to be in a very protracted period of low interest rates. I think this is a substantial risk of deflation going forward, so you have to factor that in.
So you don't have to feel like the housing market's going to run away from you. Like
no, you don't have to feel that it's running away, and obviously in a deflationary environment, you have to scratch your head twice and say, gee, do I really want to be owning rather than renting? But the fact is, I think we're going to be in an era of very flat pricing and very, very cheap money for a very long time.
So if you look at the long-term housing charts for fair value, in the May lows, we got close to fair value, but we were still 10% above, something like that, long-term. Usually, when a bubble like this bursts, you have prices crash way through fair value and end up troughing far below it. And it sounds like you don't think that's going to happen.
Well, let me give you a little nuance for that. The difference is that housing, like many other assets, is not just simply a national price level. It's a bunch of regional price levels all combined. And the biggest question mark right now will be what happens to the markets that really have not retreated. We're sitting in one right now here in New York. This market is down only about 22% from its highs, 23% from its highs. That does not reflect the mass of the bubble that occurred in increase in land prices in this area that has not retreated yet. And so where you look out to the sand states, to Las Vegas, and Phoenix, and Southern California, and Florida, and you look at those places and you say, gee, those are down 45, 50, 55%. Do we really expect a lot of additional retrenchment there? A lot of analysts look in those markets and they say that's where the big shadow inventory of foreclosures are, so watch prices in those markets. And the answer is, you know what? I don't believe there's going to be a lot of retrenchment because housing has reached the point relative to rental levels where occupancy costs are about the same. That's not the case here in New York, and it's not just the city, but the entire MSA, and it's not the case elsewhere on the East Coast. So the retrenchment, the additional retrenchment in pricing that I'm forecasting is not going to be spread equally around the country. It's going to occur in the markets that haven't retreated yet. Again, I relate everything back to price-rent ratios. I'm the guy who's first raised that issue, and I keep pointing to it. It's obvious to me. In Manhattan, for example, you look at the price of buying a co-op or a condo, and literally you can rent for almost half the amount in terms of after-tax carrying costs on both sides.
And this is even with mortgage rates.
Even with mortgage rates having come down. So that doesn't make sense long-term, and that's going to get resolved.
So how long do you think it'll take to get to the bottom in New York, for example? And then how long do you think it'll take until we hit the old high?
Oh, well, the answer to the first question is probably sometime in the first or second quarter of next year. The answer to the second question is let's look at Japan, where prices of residential real estate fell 80% at the time of the bursting of their bubble in 1990, and of course have never come back. I mean, that's been God knows how many years. You're talking about a bubble that was inexplicable, other than through market manipulation in the credit markets. That actually allowed for prices to rise to that level. And unless we have that again, there's no rationale for prices coming back at all.
Right. So real quick, from an investment point of view, do you see opportunities now in real estate in the credit markets or in land itself?
Well, I think the home builders just took another hit on the chin, and I think that people have to constantly watch them. A lot of their credit issues have been resolved. And as long as they can continue to build a meaningful number of homes, and it doesn't have to be you got to remember something. That 300,000 homes that you mentioned, I mean, our average for 50 years is 1.5 million homes a year. I mean, we are in nowheresville in terms of home construction. So the question is, the prices of the home builders, do they reflect the $300,000 level or an anticipation of a recovery? I would have said a few weeks back people were pricing in a bit of a recovery.
Not
Last
anymore,
couple of weeks, oh my gosh, they are cheap.
You own any of these stocks?
I do not.
Okay, thanks very much.